Hi, Neil O'Brien here. And a quick question to kick us off. If your business had to do an NCT style test, would it pass or fail? Obviously, we know your business doesn't have to do an NCT. I use that analogy sometimes because with business owners, it's something we can get. And I have a series of reports that I'm going to show you in a moment that can help you spot opportunities to grow your business and realize exactly where you're at. So this is video one. I call this the NCT style video. The second one is nine ideas to grow your sales by at least 42%. The two of them kind of go hand in hand. I just have a few slides here I'm going to show you. Don't worry, it's not death by PowerPoint. Okay, there's the car, NCT. And I have a number of reports there I'm going to take you through. Profit gap sounds bad, but it's actually good. Every business has one, and it's like a bucket with holes in it. If you pour in water, the water's going to pour out through the holes. Every business has holes, profit holes, and these reports will help you plug them. Find them first, and then we plug them. 5 ways formula is a good way of finding the quickest, easiest way to grow your sales. Profit and loss is an overview of your business. 80-20, my all-time favorite business topic, is about whales and sardines. Some clients are much more profitable than others, and knowing this can have a huge impact on your profitability. Cash flow forecast can be a great way of looking ahead to see if there's any problems, any speed bumps down the road. And KPI is your business scorecard. Okay, I'm going to switch over now to the spreadsheet and the templates, which you'll have with this with accompanying the video. The first one is profit gap. I've used an example here of Mary. She's a coach. Okay. So how would you work out Mary's profit gap to see if she has one? Mary has an average charge out rate of 100 euros an hour. In a typical week, Mary expects to do 30 billable hours per week. And then in number of weeks, Mary would expect, even though there's 52 weeks in a year, we know we've bank holidays. Mary would like to take some holidays like you would, I'm sure. Mary's estimating she'll work 45 weeks in a year. If you multiply out those three figures, 100 euros by 30 hours per week by 45, you'll get 135,000 as being Mary's, we'll call it her max or theoretical figure. Now, what were Mary's sales? Mary's sales last year, 90,000. You can also do a comparison to this year. So the gap is 45,000 between the 135 and the 90. If you scroll down here, with all of these spreadsheets, all of these templates, there's an example like Mary, and underneath there's an area for you to fill in your figures. If you want to, key in your hourly rate here. It'll just work that out for you. You can tweak these if you need to, and then put your sales down here, either last year's sales, or you could put this year's and annualize it, and it'll give you a profit gap. I said it's not bad news, it's actually good news. Okay. Now, the next one is the 5 ways formula. An example here of Mary. Underneath are the steps to working this out, and then there's a space down here for you to plug in your numbers. The idea of this is we want to try and spot the easiest, quickest ways to grow the sales. Mary's sales were 90,000 last year. Now we're going to work backwards from this. Now there's a formula in here, so you just need to work back. So go to number 4 and just estimate, on average, how many times would your customers have bought from you last year? I know it's an average. Don't worry about getting this 100% right. It'll make more sense when you have these numbers plugged in, and you can always go back and tweak them a little bit. In Mary's case, it was 3 times. Now, the average sale Mary charges, this is an average customer will pay 1,000 euros. Yeah, average sale. Some are higher, some are lower, 1,000 per month. Mary has had 30 clients last year. Now, Mary had 30 clients, but there's a step before that as well, because Mary has tracked this. She only converts 3 out of 10 clients. So Mary actually had 100 sales meetings last year and only converted 30 of them to customers. So 30 clients multiplied by 1,000, multiplied by 3 will give you annual sales of 90,000. And once you have these in, you can tweak them around a little bit. But the idea is to look at this and say, well, if you're looking at those numbers, where would be the best opportunities for Mary to grow her sales? Now, I think her conversion rate, it's not unusual to see 1 in 3, but it's certainly an area for an opportunity to improve. And I have some ideas in the second video that will cover that. The other thing is Mary keeps clients on average for 3 months. So a client will pay an average 1,000 euros a month for 3 months. After 3 months, Mary has to go out and find a whole new batch of clients, which puts a lot of pressure on her sales and marketing. I think Mary should be looking to build in some recurring monthly fees. And we look at that in the second video. Profit and loss is an overview of your business. If you've been in business for a number of years, you may have an accountant, you may have done a tax return. Mary last year, you can see these are her main numbers. Her sales were 90,000. She paid herself 45,000. These are her other costs. And she had a net profit of 9,000. So net profit is what's left when you've paid all your bills, all your costs. Interesting here though, normally a set of accounts will give you the previous year. Mary's sales were higher last year. The previous year, they were 124,000. So they've dropped 28%. She had a number of large contracts there that dropped out, which meant that Mary had to reduce the amount she paid herself by 22%. Now, what's interesting as well though, even though Mary's sales dropped, some of her costs went up. Training was more than double. Marketing was more than double without seeing any benefit up here. These are the type of things very useful to look at in the profit and loss. It's an overview of your business. Okay, we'll move on to 80-20. One of probably my all-time favorite topic. I totally love 80-20. I've been doing this with businesses for years. Every business has a smallish number of very profitable whales and lots of sardines that make you less money. So let's look at Mary's. She's listed off some of her sales in the last couple of months. She has a number of whales. So for example, she's a software client that last month paid her 2,700. She did 12 hours for them. Divide 2,700 by 12, you get an hourly rate of 225. And I've done the same for all the clients she's had in the last month or two. These three here are very good rates. You can see 225, 170. The rates drop as we go along. For example, the financial planner here paid her 400 euros and she did 5 hours for them, a rate of 80. Now look at the rates. I'll call these sardines over here. The rate per hour, some of these are older clients. Mary used a lower rate with them and she has them long-term, or they come back to her and she feels she has to give them the same rate. So the rate is lower and look, she's putting in extra hours. The cafe here at the end gives her an hourly rate of 33 euros. Over here, the software client is 225. Mary would have to sign 7 cafe clients to replace. If she lost her software client, she'd have to actually work with 7 cafes. So these are much more profitable. So what I'd be looking to do, Mary, is get more of these on board and filter out some of these sardines here. On cash flow forecast, I have 2 of these. One is historic, you're looking backwards, and the other one is forward. So this is a profit and loss, her cash flow profit and loss. So the easiest way to explain this is if Mary, say in the first week in February, she's online banking, she can go in and print it off or look at it and key in her cash in and all her costs month by month. So for example, in January, Mary had 6,200 came in. She spent almost 10,000. So the net in the month was minus 3,759. It was an expensive month for Mary, but the following month was a little bit less. As we go along here, a lot of them are positive. Say, for example, in June, 8,400 came in, 5,500 went out. She had a positive 2,916. This is a great, you can do it weekly or monthly, but it's giving you a picture of the business as you go along. Now, the same report here, cash flow forecast, can be used looking forward. Now, for example, Mary had projected that July and August were going to be good months. However, some clients dropped off. They were going away on holidays for the summer. So her sales dropped dramatically in June and July, from June to July, down to 8,400, down to 2,000. So Mary has to look at this, but look, it'll give her a picture into the future. So Mary's looking at this in June. She can see if she has 3 poor months, 2,000 coming in, her costs would stay the same, or should stay the same, until she gets to September. Now there's a problem. If Mary doesn't get her sales up, she probably can't afford to pay herself the full salary. So it's a brilliant report for projecting forward. And the last one I'm going to look at is a scorecard or KPI. Here you can track all the key weekly numbers in your business, cash in, invoices out, billable work. If Mary wants to sign 3 new clients per week, she'll need 3 sales meetings. What marketing activity is she going to do? And again, I'll touch on this in the second video because referrals is a big part of what we cover in the second video. So what I'd say to you is plug in some of those numbers, see how you get on. I'm sure you'll get some insights into your business. And in the second video, we'll cover ways and ideas to grow your sales. Okay, thanks for listening.